In the context of globalization and the close interconnection between economies, emerging countries, particularly in Asia and Latin America, are becoming increasingly dependent on international financial markets, especially the U.S. government bond market. The issuance of U.S. bonds has become an important means for these countries to raise capital in order to promote economic development, address budget deficits, and maintain financial stability. However, this dependence on U.S. bonds, while potentially beneficial in the short term, carries significant long-term risks for these nations, especially as the U.S. dollar becomes the primary factor in debt repayment.
The causes of dependence on the U.S. bond market. To understand why emerging countries rely on U.S. bonds, it is first necessary to explore why these countries issue bonds in U.S. dollars. Emerging economies, particularly those with uneven or unstable development, must seek financial resources from international markets to boost growth and develop infrastructure. Since the U.S. dollar is widely accepted and easily exchanged in global markets, many countries choose to issue bonds in USD as a way to attract foreign investment. The policies of the U.S. Federal Reserve, Fed, also play a key role in driving this dependence. When Fed interest rates are low, issuing U.S. bonds and borrowing in USD becomes more attractive to emerging economies due to the lower borrowing costs. However, when the Fed raises interest rates, the value of the U.S. dollar increases, exposing these countries to negative impacts in repaying their debts. Additionally, international financial institutions such as the IMF often require emerging countries to borrow in U.S. dollars when they face financial difficulties, further deepening their dependence on the currency.
The phenomenon of dollar-denominated debt and the risk of default. Dollar-denominated debt refers to the situation where emerging countries borrow in U.S. dollars. This exposes them to significant risks when the U.S. dollar strengthens. When the USD appreciates against other currencies, particularly the local currencies of emerging nations, the cost of debt repayment increases, as these countries must spend more to convert their local currency into US dollars to service their debt. This can lead to budget imbalances and financial instability, as these nations cannot control fluctuations in the value of the USD. A typical example is Argentina, a country that has struggled with dollar debt for many years. During the 2001 to 2002 financial crisis, Argentina issued bonds in USD to raise funds for the government. However, as the dollar strengthened, Argentina was unable to maintain its debt payments. So, as a result, the country faced the largest debt default in its history in 2002, triggering a deep economic crisis, weakening its financial system and leading to a prolonged cycle of debt restructuring. Similarly, Brazil is another emerging economy that has experienced dollar debt issues. The country borrowed in USD to finance infrastructure projects and social programs. Fluctuations in the value of the dollar significantly increased repayment costs, especially when the Brazilian real depreciated against the USD. This situation heightened the debt burden on the government and placed considerable pressure on the economy. As borrowing costs rose, the national budget experienced deficits, and financial policies had to be constantly adjusted, creating challenges for sustainable economic development.
Impacts of dependence on U.S. bonds. Dependence on U.S. bonds and borrowing in U.S. dollars brings both benefits and risks for emerging economies. On the positive side, issuing USD-denominated bonds provides these countries with financial resources to invest in development projects, drive economic transformation, and improve infrastructure. This can lead to job creation, stimulate consumption and investment, and ultimately improve the quality of life for their populations. However, the downside of this dependence is that emerging countries are exposed to exchange rate volatility and interest rate risks. When the U.S. Federal Reserve, or Fed, adjusts its monetary policy, the value of the dollar may rise sharply, increasing the cost of debt repayment. This loss of control over debt levels can push these countries toward default or force them into debt restructuring, as was the case with Argentina in the early 2000s. In addition, these countries also face the risk of capital flight. When U.S. interest rates rise, international investors often shift their capital from emerging markets to U.S. bonds, which become more attractive due to higher yields. This reduces access to capital for emerging economies, making it harder for them to maintain financial stability. Challenges and solutions. The dependence of emerging countries on U.S. bonds is a complex issue that offers both advantages and hidden dangers. These nations must work toward diversifying their financial sources and strengthening capital flow controls to reduce reliance on the U.S. dollar. Furthermore, developing domestic bond markets and building foreign exchange reserves in local currencies can help mitigate the risks associated with dollar-denominated debt. In the future, emerging economies need to adopt more sustainable financial strategies that enable them to maintain financial stability without over-reliance on external factors, particularly the volatility of the U.S. dollar and the U.S. bond market.
The imbalance of the global financial market. In today's global financial system, the reliance on the U.S. dollar, USD, and the U.S. bond market has created a serious imbalance in the global allocation of assets. Although the USD has long held its position as the dominant reserve currency and the main medium of exchange in international transactions, the fact that most countries in international financial institutions concentrate the majority of their assets in USD has led to a concerning dependency on the U.S. and its financial policies. As a result, both developed and emerging countries seem unable to manage their financial assets independently, becoming vulnerable to fluctuations in the USD and decisions made by U.S. financial authorities. This imbalance stems from the fact that a large portion of global foreign exchange reserves is held in USD. Countries maintain foreign reserves to ensure economic stability and the ability to meet international payments. However, since most of these reserves exist in the form of U.S. bonds or USD-linked financial instruments, countries cannot freely manage these assets when external factors shift. This dependence on U.S. financial decisions, especially those of the Federal Reserve, Fed, has resulted in a financial system that is monopolistic in nature and could become a global debt bomb if not corrected in time. One clear example of this imbalance is the fluctuation of the USD and its impact on emerging economies. Countries like Brazil, India, and Turkey frequently face exchange rate instability when the USD strengthens. When the Fed raises interest rates to curb inflation or adjust monetary policy, the USD becomes stronger, forcing these countries to pay more for their debt and decreasing the value of their assets when calculated in USD. This increases their debt burden and weakens economic resilience. These countries are bound by a factor they cannot control, the volatility of the USD, and must constantly monitor the Fed's decisions to react accordingly. This situation creates a state of constant anxiety for USD-dependent nations. The concern is not only about the dollar strengthening, but also about the U.S. unilaterally changing its financial policies without consulting other nations. Decisions like raising interest rates or expanding monetary policy can have direct and immediate impacts on other countries, especially those lacking sufficient USD reserves to cope with financial shocks. This does not just destabilize national assets, but also raises the risk of default and financial crises. Moreover, concentrating reserve assets in USD leads to a lack of diversification in national asset portfolios. If a country holds most of its reserves in a single currency, any depreciation in that currency's value could result in severe consequences for financial stability. If countries want to diversify their reserves and asset structures, they will encounter major obstacles, as the USD still dominates global financial markets, making any shift toward alternative assets extremely difficult. This imbalance in asset allocation is not merely a short-term issue, it could have lasting consequences for the global economy. While developed nations like the U.S. benefit from the dominance of the dollar, other countries bear unpredictable risks, from currency volatility to unmanageable policy shifts. This reality calls for a rethinking of global asset management, reducing dependency on a single currency and building a more flexible global financial system, one in which countries can exercise more autonomy over their assets and respond more effectively to market fluctuations. In the future, if nations wish to reduce their reliance on the USD, they will need to find alternatives, such as promoting the use of other currencies in international trade or developing new financial instruments that reduce the risks of overconcentration. However, this transition will not be easy, as the USD's dominance has been entrenched for decades and is tied to numerous global economic interests.
The future of the U.S. bond market.
As the global financial landscape changes rapidly and dependence on the USD continues to shape the world economy, a pressing question emerges. Will countries seek to reduce their reliance on U.S. Treasury bonds in the future? U.S. government bonds have long been considered the safest and most common asset in the investment portfolios of central banks and international investors. However, with rising concerns about the long-term stability of the U.S. bond market, strategies such as diversifying foreign reserves could become a future trend, potentially shifting the structure of global finance. Yet fully replacing the U.S. dollar remains a significant challenge. Long-term dependence on U.S. bonds. The U.S. is not only the world's largest economy, but also holds significant political and military influence. As such, U.S. government bonds have become a safe haven asset in the global financial system. Countries hold U.S. bonds not just because of their liquidity and stable returns, but also because they trust in America's political and military stability. U.S. bonds help countries maintain financial stability and are widely used as instruments for managing foreign exchange reserves. However, the rising volatility of the U.S. economy and the country's growing public debt have sparked concerns over the long-term stability of the U.S. bond market. Over the years, America's national debt has soared, and many countries have begun to realize that holding too many U.S. bonds could pose risks to their financial security, especially since the U.S. can change its fiscal and monetary policies unilaterally without consulting other nations. Foreign reserve diversification, a new trend. One strategy nations are increasingly adopting to reduce their dependence on U.S. bonds is foreign reserve diversification. This includes shifting part of their reserves into assets such as gold, euro-denominated bonds, or Chinese renminbi. Countries like China and Russia have begun implementing such strategies with the goal of minimizing risks associated with USD fluctuations and enhancing financial independence. Gold has historically been viewed as a safe haven asset. In times of financial instability, countries like India and Russia have increased their gold reserves not only to preserve asset value, but also as a response to concerns about U.S. bond market stability. However, while gold is effective at preserving value, it cannot fully replace U.S. bonds as a global reserve asset due to its lack of liquidity and yield generation. Euro-denominated bonds are another potential alternative, especially as the European Union continues to grow and may provide financial instruments with stability comparable to U.S. bonds. Still, the Eurozone faces internal challenges, including sovereign debt crises and political instability, making it difficult for countries to place full confidence in the euro as a long-term USD substitute. The Chinese renminbi, RMB, representing the world's second-largest economy, is also seen as a potential alternative. China has promoted the international use of the RMB through initiatives like the Belt and Road Initiative. However, China's strict capital controls and lack of transparency in its financial system remain major obstacles preventing the RMB from replacing the USD anytime soon. Despite efforts to introduce RMB-denominated oil contracts and international trade settlement in RMB, China still needs to address significant issues regarding financial liberalization and currency convertibility for the RMB to become a true global reserve currency. The major challenge of replacing the USD. While many countries are seeking ways to diversify their assets and reduce dependence on the USD, a key issue remains. There is currently no viable alternative to the dollar in global finance. The USD's strength comes not only from the U.S. economy, but also from its high liquidity, political stability, and the massive scale of its financial markets. No other currency currently meets all these criteria to serve as a perfect substitute. Other major currencies like the RMB or euro still face significant barriers, including political concerns, financial system structures, and market trust. The outlook for the U.S. bond market. The outlook for the U.S. bond market will undoubtedly be influenced by changes in the U.S. economy and Federal Reserve policies. While there is a growing shift towards foreign reserve diversification, a fundamental transformation of the U.S. bond market is unlikely to happen quickly.
Countries will need time to build a new global financial system, one where other currencies can compete with the US dollar. Until then, the USD is expected to maintain its dominance in global finance, and the US bond market will continue to play a crucial role in preserving international financial stability.